Hello, everybody. Welcome to Friday, another Talk Money with Tom show. Really excited that everybody's here today. Our objective is to try to help you have a better retirement, especially financially. We do that by answering your questions. So this is a place you can come for free, ask any question you can think of, and you can even ask them during the show. See if you can come up with something that you want to learn about today. You send that question into asktom@talkmoneywithtom.com, or you can put the question into the chat box here on the show. Either way, we'll try to answer those. You can send those questions during the week. And we also answer questions that kind of came up in our strategy sessions with our clients. So really looking forward to being able to do that. We focus on, asset management, retirement planning, and tax planning are the three big areas. And we feel like education is a really important component to be able to have a more successful retirement. So even if you're dealing with an advisor like us, the more you know, I think the better that your retirement could be. And so we established this Talk Money with Tom channel. We have over 1,000 videos on here. You can go look at those. You can subscribe to this channel if you want to kind of, up your game, so to speak, and your knowledge level. And then, of course, you can hit the little bell button if you want to get notified when we put something new on there as far as that goes. And, the last thing that you might be able to do is just set up an appointment with Eason and I, like a 30-minute phone or video appointment where, you get a chance to ask your questions to us in private, or, maybe a custom situation might be able to help you with. So you do that by going to our website. There's a book appointment button up in the corner. Hit that, and you can set up a time with us. Our schedule is live on that calendar. So look forward to being able to help you today. Really excited about today's show. All right, so I do like to start off the show as usual with just commentary about what's happening with the stock market. This is actually one of the more popular areas right now. It's just the thought process of what's going on. This has been a really interesting year. Got a chart here of the S&P 500 so far year to date, and you can see what's happened. That red line shows kind of the overall trend, which has been down. Had a couple of challenges to that trend line, both of which failed, but now we're down back right at this low that we established back in June, and that's really critical. This is the critical point in the market so far, in my opinion, and we're really kind of watching for what's going to happen here. But on the news side, and this is kind of interesting, this just came out today, is what they call the PCE price index. So the PCE stands for Personal Consumption Expenditure, and this is the favored version of the inflation numbers that the Federal Reserve uses. So most of us are familiar with CPI, and that's what we're used to hearing about. The Federal Reserve pays attention to CPI, but when they're targeting inflation, they're looking at PCE. And so that just came out today for August. PCE comes out pretty late. It's a month later, kind of the end of the month for the month prior. And so it doesn't get as much attention, but it's actually more important than the other, inflation numbers because the Fed pays the most attention to it. So this, you can see on this pattern here right now, PCE dropped to 6.25% for the month of August, and we hit a peak there in June, okay? So not bad. We'd like to see things come down and what have you, but the main focus for the Federal Reserve is not the overall PCE index, which we're looking at here, but what they call the core index. And that's where they take out food and energy. And so here's where the problem lies. So core had actually grew last month. And you can see, kind of peaked out back in March, and then it jumped again in June, but it's coming back up. I'd say the overall trend is still down, but even this 1 month movement upward makes the market very nervous because it means the Federal Reserve might have to push harder and harder. And certainly it's the wrong direction. Mm-hmm. I mean, if this month would have been down, okay, great. We had that one, blip in June, and we're just going down, 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 down. The market's probably doing pretty well in that environment, mm-hmm. right? So that's what's happening here is we've got this sticky inflation. We saw the CPI number actually go up more than expected for August also. And so this is what's kind of driving the market. The Fed is being very, very aggressive in their projections for what they're going to do, their wording for what they're going to do, and very aggressive actually in raising rates. So they are, 0.75 points 3 times in a row is pretty amazing. So and that's creating some problems for the market. But I get back to kind of the big story here, which is this S&P 500 chart. To me, this is the key issue for what's happening right now. We can look at inflation, we can look at all the reasons for things that are happening. If you really want to pay attention to what's going on to the market right now, you have to pay attention to this chart, because we've had this, basically 24% downturn on the S&P 500 from the high that was established way back at the very beginning. And one of the things that happens here is now this could be, okay, this is really important to understand. What the market's doing right now could be the sign of a reversal back up, break through that 200-day moving average you see there, that blue line, and reestablish a new uptrend. Retesting lows is often something that happens. And so the low that was set back in June, we're retesting that right now. And so really, there's nothing wrong with what's happened here. Even though we don't like to see the ups and downs and what have you, this could be a really good place. The problem is that we're seeing some signs that the testing of that low is kind of breaking down. First of all, we did break through that low, but it's more of a zone, right? So that's okay to break through it a little. But Wednesday was really fascinating, because Wednesday the market really jumped upward. It came down to that low and really moved, and it was 6 stocks up for every one down that day. Really good day. There should have been some follow through, 2, 3, 4 days. Maybe that takes a rest and then continues to go. That would have been, that kind of breadth, that thing that we look for, that volume and jumping. We had that for that day. And so it was looking good. See what happens. But then the next day it failed and gave it all back. And today we're hitting, lows again. And so, we'll see. I don't know that we're going to know everything until next week, maybe. We'll see what happens. It's okay. Where we are right now is almost like a no man's land. Now, we did start back in August 30th to start to reduce the exposure that we have to the stock and bond market, mainly because we kept getting triggers to sell and didn't have triggers to buy anything else in replacement. And so we just kept moving that money into T-bills and ultra short-term bonds, because that's actually a fairly rare environment. Usually you have it says to sell this, and we find some other triggers to buy these other things. We have a very disciplined system as far as that goes, and we're not getting any buys. So that's kind of another warning sign to me that things could be a little bit hairy here. And so we continued to get those pieces out of the market over this time frame, basically over the month. I mean, August 30th is now 9:30. So, and then last Thursday, one of those sell signals we took and we pushed that, instead of into T-bills and ultra short-term bonds, we put that into the inverse, the ProShares short S&P 500 inverse goes the opposite direction of the S&P 500, ticker symbols SH. And we're up almost 4% on that now since last Thursday, which isn't a huge rate of return, but not terrible for a little bit over a week.
Yep.
But even better considering that the market's down roughly about 4% since then. Again, it's one thing to go the opposite direction of the market. It's another thing to capture that gain and get back in. So, we'll talk about some of the buy signals and things that came up as a question this week too. But one of the things that is just critical to understand here is when I talk about being on the edge of the cliff and packing the parachute and all that, this is the cliff right here. Because past this point, let's say the market breaks through here, basically we have to start all over. The whole bottoming process just ended if we get through this. And now we're still looking for that bottom. And, someplace below where we are now, and then we'll need to see that big stretch, usually some kind of bounce, some kind of breadth coming back. And we start off with a new bottoming process. So now, again, for clients of ours, for the most part, our models are in T-bills and ultra short-term bonds, which are doing, okay in this environment. They're not falling as, like the stock market is here, that's for sure. And then we have an inverse position. And yesterday we added to that inverse position just based on some of the negative things that I saw happening in the market. And we, not a lot, but we bought some of the ProShares short Dow. So it shorts the Dow index. We added that yesterday. So anyway, those are pieces happening. we'll have to see what's going on. But this is kind of a critical period of time to watch. Again, for our clients, we're already out of the market. We're actually making money when the market goes down. And again, I know that sounds very strange, but that's kind of where we're at right now. And we'll have to see, kind of how that plays out. We still do have exposure to the market with clients that have legacy positions, clients that have positions that we purchased long ago with big capital gains. So there's still some, exposure on both sides for the firm as a whole. So every one of our clients might have a slightly different experience. But the models, which is where most of our money is, are currently in an inverse position, which is unusual for us, that's for sure. But this particular cliff is concerning to me because the next support level that I see below this is about 11% below, and there really isn't much support in between. I'm sure it'll stop someplace and make some runs and what have you, but you could get into a cascading fall situation, and that's what I want to be really careful of. So I hope things turn around. I hope this is the bottom. I hope that we start to see some buying come in. I hope that we see, inflation coming down, and the Fed starting to talk more reasonably about that. But, one of the problems we have right now is with this type of pressure, with rates coming up, with the dollar coming up, it exposes the world to more potential problems. It's this type of environment where we had WorldCom and Enron and Lehman Brothers and Bear Stearns. When you raise rates and you have this type of tight liquidity, those things that are on the edge, well, Greenspan's saying, I love it, right? When the tide goes out, you get to see who's swimming naked. The tide is out right now, and let's see if that creates some real problems or not, right? It could be a country, it could be, a company, it could be, anything. Usually the biggest, scariest ones are the ones that we aren't even talking about, right? Those are the ones that cause problems. I'm not saying that's going to happen, but it's more likely and more pressure on those situations because of what has happened so far, right? So that's why you want that parachute. That's why you want to be cautious here. I'm usually completely optimistic. This entire channel was actually started off optimism. But this is basically like a 2008 type downturn. You just got to be careful that we don't end up in the downdraft all the way to the bottom as far as that goes. So anyway, that's what we've got going so far, and look forward to kind of talking to you again about this next week. Again, if you're my clients and our clients here at the firm, rest easy. We're actually well positioned for what's happening right now, and we'll keep you up to date as to what we're doing and how we're making those changes. But overall, I think things are just something to watch right now. We're just waiting. Kind of the same message we had last week. We just hasn't resolved itself yet. All right. Thank you very much. All right, so we have questions, some of which have come in from clients over the week, some of our strategy sessions and what have you. So let's go with the first question.
So now that you're out of the market, what are what are you looking for? What are your buying signals to re-enter the market?
All right, so let's just start with, that's kind of a radical conversation. Now that you're out of the market, this is not something you would want to do very often, in my opinion. You kind of want to stay in there, especially from that kind of the top to the negative 20%. The recovery times are too fast. Even if you got out, you probably get back in at a higher point, all those type of things. You get past that 20%, it does start to get scary, and the recovery times are a lot longer, so then it might make some sense to get defensive. So keep in mind that this is not something that is normal, but this is not a normal situation. We have a pandemic creating problems in China, for example. We have a war in Ukraine, which is creating some inflationary pressures, and we've got inflation that is really high. This is my 36th year in the business, and the last pandemic was in 1918, so this particular data set is pretty incredible. The things that are happening right now, and especially with this really high inflation. So you get out. We got out. So far it's worked. Okay, great. Matter of fact, the S&P 500 when we first started getting out is about 10 or 11% higher than it is now, so that looks spectacular. And then our inverse is about 3.8%, higher than where we are now, so that still looks good. But then you have to get back in. So how do you get back in? How do you kind of try to capture some of that profit and those types of things? And so that's what the clients have been asking, and I appreciate that. So I put together a slide, and I'll show you kind of what I'm looking at here. There's a lot of density on this slide, but what I'm showing you here is the downturn in 2008. And so one of the things we're doing right now is modeling the downturn in 2008, because if you line up this downturn kind of day by day with the downturn that happened in 2008, they're very, very similar. And the thing to keep in mind is that, the stock market is a representation of human emotion. And so although things may be different, you might have a pandemic instead, and we didn't have that in 2008 and all these things, human emotion hasn't changed since 2008 enough to make a huge difference. So we're modeling our sell and our buy signals around this particular downturn because we are actually tracing this downturn as we speak. Might change, right? But as we speak, so far this year, we've traced this downturn. Where you see the ups there, we had the same ups in the number of days in March and July, for example. We had the same low. It's amazing how much we've traced this kind of on a day-by-day basis. So what we're looking for here is some signals for when we find a bottom. And there's some signals that aren't on this chart. What the Federal Reserve is saying or doing. Do they start to at least raise rates at 0.5% instead of 3/4? The big thing that's usually out there is this scenario for most of these bear markets where there's some inflationary environment. The bottom has come when the Fed actually started lowering rates. So maybe that happens next year, and that's a good point. So we'll see how that goes. The yield curve we look at, right, and we look at the leading economic indicators. All of these things are part of that kind of what I call kind of that fundamental analysis of the overall market, and there's a lot more. But when you get into this scenario, looking at the price movement and what's happening in the price is one of the better ways to go, in my opinion. And so you're going to get a couple situations. Number one is you're going to get these extreme stretches. And so there's a green line across here, and that's what's called the relative strength index. And that's on a customized basis for each one of the securities we're looking at. This is SPY, the S&P 500 ETF from State Street. And so we customize that time period and this is 26. So it's 26-day time period for that particular security. Maybe it's 22, maybe it's 16, whatever it is. And when it gets to an extreme stretch, we want to start nibbling back in. And I don't believe in fully getting out all at once, which we didn't. We did piece by piece by piece. I don't believe in getting fully back in either, piece by piece by piece, depending on different signals. Because if you do wholehearted, you're basically saying, I know what's going to happen. And you don't. Nobody does. And so you do those little pieces and you wait and see what happens, and you just keep going in that direction. So the stretch is one area we look for, and there's a couple of arrows in there that show where those stretches are. And they weren't the perfect buyback point, but they were certainly better than the top. And then we use a set of Bollinger Bands, which are customized for this particular security for this time frame. We look for buys and sells out of that. We use a moving average crossover. So, again, optimized for that security. And so when that, crosses over one direction, that would be a sell signal. When it crosses over the other direction, that's a buy signal. And for example, we're using a 1260 crossover right now on SPY, exponential moving average. And, because that's tested out extremely well. And it's actually worked fairly well for us right now in this market also. So I feel good about that. Moving averages can be kind of late, especially in the buyback period. So that's why you want to have these other pieces. And then one of the other things that's a little hard to see, but there's some little pink dots and then some green dots that kind of blend together, almost look like a line here. But that's an ATR trailing stop. That's actually very, very interesting. There's a red wiggly line underneath there. That's the ADX, which shows the trend. And then the thing that's right over my shoulder here is called the Fisher transform. And that's actually a very early indicator, but what it does is it shows the cycles, and it's really fascinating piece. So these are some of the pieces we look at on these charts to kind of determine, when do we get out, which has worked out pretty well so far, in this particular, last month anyway. And then, when do you get back in? So we have these different signals. We'll be nibbling back in when we get those and such too. So anyway, that's the answer to that. When do you buy back in? Because we've been telling the clients, hey, we got out and we're inverse and it's working, and that's their first question. Okay, we have signals to get back in, because that's the best question you can ask because. Yeah, I think we're almost up 4% on our inverse position that we bought last Thursday, but that doesn't really matter unless you can capture it. Yeah, you buy back in at a higher point, then you might as well just stay in there, right? So that's where these signals are really important and kind of tracking what's happening there as far as that goes. So we'll see how it plays out.
As an average investor, should you be trying to time the market like this, or most people go with the wisdom to just buy and hold?
Yep.
And not time the market because we're pretty terrible at it, honestly.
Well, yeah, it depends. So I'm scratching the surface here. I'm giving you maybe 30% of what we actually look at. And so this is, decades of work and study and watching the market every single day by the minute. And really started at a very, very young age. And so should you be doing this without that information and that knowledge? Looking back at some of my past mistakes when I was younger and didn't have as much experience, I'd say you should be pretty careful about doing anything on your own. However, the dollar amount matters. So how much money is it in total? Is it $300, or is it $3 million, $6 million, $10 million? So we deal with a lot of big dollars too. So that's a big difference to me, because a 10% loss on 3,000 is 300. A 10% loss on 3 million is 300,000, which is much harder to get back. And then how much of that money is your total asset base? So are you risking 5% or 95%? And so that's how I would answer that, is just the importance of it. And so buy and hold, I think, works quite well, except for the fact that you've got a lot of people currently in our practice that are retired. And one of the disadvantages of that buy and hold is that they're withdrawing from these assets. And if you look at this 2008, chart, that gets to be really expensive. You're taking out more and more shares to get the same 2,000 a month, 3,000 a month, whatever it is that you're trying to get out of there. And so trying to kind of stop some of that slide at some point in time. If it works, you can kind of cut off some of that recovery time and come back a little bit faster, which is even, it's hard to do when you're taking money out. So it depends on your age and, if you're adding money. We have some younger clients. I've been basically keeping them in for the most part and trying to encourage them to add money to this, And so, again, it does depend on situation as to what you should do. But, our clients, we have a vast majority of the net worth. They are older in general, and the dollar amounts are big. So to me, you got to put the parachute on at some point. You got to protect assets at some point in time. Because, buy and hold, one thing that people miss on buy and hold is the Great Depression. They think that that can't happen, and maybe it won't. But the Great Depression was down 86%. So if you take $1 million, right, and you put it in the Dow at the top, it's now worth $140,000. You lost $860,000. And it took 14 years for the Dow to get back, so you have that million. That's a heck of a long buy and hold scenario. If you're 20-something, man, it's not so bad maybe. Maybe if you kept buying, let's say you're 74, that's a big difference. Now the market's not coming back until you're 86 and you're still withdrawing from it. Your chances of actually getting your money back to where it was is even less because you're withdrawing. So it does depend on where you're at as to what you should be doing as far as that goes. Now, within that overall framework, you actually want to also be at a certain level of risk to start with. So we have 10 different portfolios from 10% stock all the way out to 100% stock in 10% increments. And so, you want to be in the right portfolio that will allow you to buy and hold through this, because you might not be able to get in and out and those types of things. The 2020 downturn is a great example. It dropped so fast, 35%, and the fastest drop of 35% in history, that really all you could rely upon was your overall asset allocation as far as that goes. So very, very good question. Yeah. All right. All right, what's our next question?
So, how does asset allocation affect my probability of success?
Oh, okay. So asset allocation, probability of success. So actually, this is a question that's coming up, maybe in a different way, but it's basically the clients are asking, because in our particular system, all of the assets and account values feed in, every day, and then that disseminates into different places. You obviously have your portal at TD Ameritrade that we use. You've got your, Black Diamond portal that we use for performance reporting. Clients can go in and look at that, but it also links into our financial plan. And so we've had some questions like, oh, wait a minute, I was at 90 some odd percent probability of success, and now it dropped a whole lot. What happened? Mm-hmm. Why is that happening? I know the market's down, but I went down from 90 to 40 or something, along those lines. And so that has to do with the fact that, we're currently in essentially T-bills and ultra short-term bonds and this inverse position for most of these clients. And the financial planning program looks at the long term. It says, oh, you're going to have that for the rest of your life. Well, no, that's not true. But I'll give you an example. This is what we're seeing. So, here's a client who had a great probability of success on the Monte Carlo simulation, and now they go in and they look at it, and here it is, 50%. Mm-hmm. And so they're a little bit worried because, oh, what happened? I lost all my money or something? No. It's just that the program is looking at that allocation and saying, okay, at that allocation for the rest of your life, it won't work, which seems fairly obvious. That's why nobody uses, 80% T-bills, unless you have a lot of money.
Yeah, if you can get to a point where you have enough of a buffer, you
yeah,
could just go pure cash.
That's right, exactly. And so it kind of depends on what you're spending, what your lifestyle is, how that balance works out. But if we look at kind of the different allocations, so this first allocation over here with the most green on it, it would be kind of that 80% bond, 20% stock. That's what created that 50%, probability of success for this client. But the one in the middle is the one that they're usually on, which is 60% stock, the rest bond. And so, the program has shifted their portfolio to where it is, which is this first one. And so maybe under this other scenario, they've got a higher probability of success. And then we actually just put in here, for example, 100% stock portfolio mixture as far as that goes. So you can kind of see them. So what's fascinating here is the average rate of return, that would come out of this on a projected basis. It's 5% for that most conservative. Looks like about 8% for this one in the middle, and 10% for the 100%. Now, doesn't always mean your probability of success is going to be better.
Yep.
Because we run all these through for that same client, and so 50, that's what they're worried about, but they're really at 85. Because we're going to go back to that 60% portfolio at some point here, and we're not going to be in this conservative thing for the rest of their life. Mm-hmm. But what's very fascinating here too is that if we go out to 100%, where the average rate of return was higher, because the volatility picks up so much over the course of somebody's life, it just exposes you to other big drop-down events, and the probability of success actually dropped there.
Yeah.
That's not something a lot of people think about. Oh, I make more money if I take more risk, which is true. But when you're withdrawing from that and you're living off of that and you're in retirement, you got to find the balance. Now, sometimes it does work. We get actually higher. And again, it depends. To the same comment you just made about cash can go the other way. Mm-hmm. I have other clients that have told me exactly that. I have enough money. I can take more risk. And they do. And, obviously it's worked out for them over the long term because they have enough buffer that if that risk doesn't pay off. So in this particular case, right, there wasn't quite enough buffer to go all the way out to 100% stock. Mm-hmm. But that's why we want to look at this. It's different for everybody. So be careful to draw conclusions for yourself off of this. That's why we're here. We can go through that process, with the clients and kind of analyze that and figure out, what's going to work there. So, it's quite fascinating, actually.
Yeah, and for clients, if you see your success chance drop rather drastically, it's probably because we're in a defensive portfolio, and that's not what we're usually in, and so your plan's kind of using that for your lifetime, and so it's dropping your probability of success.
Yeah, exactly. All right. What's our next question?
So, my husband and I are moving out of state. We know we can do this financially, but what are other things we should consider before we make this move?
Yeah, we've seen this a lot within the practice. I think we have clients in 26 states outside of California, and all over California for that matter, but moving out of state. And one of the reasons is because we have this ginormous appreciation of real estate here in Silicon Valley. And that allows people then to kind of capture some of that and move to Arizona or Nevada or Tennessee or Texas or, wherever it is that they want to go. And so it is kind of interesting to us, to watch that process and, how did it work? What's the feedback? What should people be watching for? And I would say, for me personally, just looking at what's going on, I would say the health care of the area has got to be something that you look at. Because I have a client that moved up into a very rural area, very pretty, really excited to be there, had some land even that they wanted, to do some things. And they got a kidney stone. And there's a van that would come around about every 3 weeks that had the ultrasound in it that would, break up the kidney stone. He was in quite heavy pain, had to wait for 2 weeks for the van to come around. So, you got, as you get older, there's more chance to have more medical issues. And so we've had clients that have had Parkinson's, and we have clients that have had cancer, and they're in these areas, and all of a sudden they're having to, drive back to these more dense areas where there is better medical facilities and what have you. So I'd say taking a look at healthcare. Every place says they have great health care, but if you're living here in the valley, you are leaving some really good health care. You might not find that in these other places, but I think that would be a good consideration in terms of trying to figure out, where you might go.
Yeah, and some other things that I think you should consider before picking a spot is weather. How's the weather? If you're in the Bay Area, example, myself, I lived out in Boston for college, and I did not do well in the winter, so I decided to come back to California. And so, can you handle the weather there? Another one is the demographic. Are you in a place where you're happy with the people around you? Do you want to be in a college town? Do you want to be in kind of an older retirement community? And also disasters. Are you moving to somewhere that could have a bad disaster or, prone to disasters? That's another one you should consider.
Yeah. I have a client, and not many people do this, but I thought it was really wise. They had targeting different areas that they were interested in, and they were renting Airbnb, so they could kind of be in a house in relatively area that they might end up in, and they would go for a fairly long term, 2-4 weeks. And they were already retired, so they had some time, and it was fun for them, and they got to go all over the place, and that allowed them to kind of really narrow down where they wanted to go and make that decision. I mean, it's not easy to move, right? You don't want to have to do it again and find out you don't like it. So I thought that was really wise. It does take some time and even a little bit of money, for renting the place. But I think that's interesting. One other consideration that I would think about too, just has to do with you're about to sell an asset. It might be one of your biggest assets, which is your home. Is this the time to sell it or not? And so, because I get too many people that are lining up with, kind of these thought processes. Well, you only sell at this time, it's a spring or, whatever. Well, in this year, for example, you were better off selling in January and February than you were in the spring and April, May, and June, just because the rates of mortgages went up so much. And that really softened the market. So I would be looking at least from a pure financial standpoint, trying to deal with some of the peaks and troughs. Now, you're going to sell for less possibly, and maybe you can buy for less too. So that's a good thing. But that's just something to consider there as part of the calculus for when you should move. Is how do you maximize this asset that you have as far as that goes. So because right now is a tough time to sell, might be interesting time to buy, but you're most likely doing this to sell something that is bigger, more expensive, to buy something that is cheaper. So if you lose, $500,000 on the price of your property here to go buy a property that's $100,000 less, Yeah,
Net difference is pretty worse.
yeah. So and that's the problem, right? So yeah, you're getting that other property for cheaper, but it was smaller, and you're losing more money on your big property. And so trying to find those times where, and again, it depends on your flexibility as far as that goes, and kind of wait through this and see if the market can stabilize and get going again, and that kind of stuff. So I definitely consider the value of the home as part of that. And boy, it was interesting to watch. You could see people just kind of jumping on the bandwagon to get out of here, when those prices were really going. And now you're seeing those people that just missed the bandwagon, whose signs are still up on their front lawns, waiting to sell. Yeah. And so I do think that's a piece of the puzzle. I'd certainly be considering that if I was planning on moving out of the state. I had a client very intelligently didn't want to move out of the state because his job was continuing for a couple more years, sold anyway, right near the top, got way more than asking, and just as renting a place, he just wanted to capture the craziness. Mm-hmm. And if he waited, it would have been around now, actually about 6 months from now, and he wouldn't have gotten that same price, I don't think. Mm-hmm. So really smart move there, but kind of a hassle. He had to move out, got to move twice. So anyway, but that's, sometimes that's worth it.
So, what are seasonal market patterns? Like, I've heard of the Santa Claus rally or the rally after midterms, but why do they happen?
Well, seasonal rallies, there's all kinds. September's annually one of the worst months. Turned out to be pretty true this time. I think the S&P 500 was down almost 8% this September. A lot of people think October's the worst because we've had some big crashes, like the 1987 crash in October and what have you. September is the worst. And then you get these, Santa Claus rally, which ironically, in my memory, was January. That was the better month. And then all of a sudden, December became the better month. And my guess is that people were trying to get ahead of it and get in there. And, so there's, there's another piece of that, and just that you get more information about consumer behavior. Is it a good Christmas? Is it a bad Christmas? And those types of things. And so, U.S. consumers are pretty good, so sometimes we have some pretty good Christmas sales that are going on in terms of what the consumers are buying. This midterm one's, I think, most interesting right now because I've seen a dozen articles, I think, on this where they go back, say, 70 years, looking at these midterm election years, and there's a very strong pattern actually, and to have any pattern at all is actually a miracle in and of itself. But this has a very strong pattern where the market bottoms out around the middle of October to the end of October, and then rallies for the rest of the year. And midterm years can be quite positive on average. I think 10% was the average rate of return, with most of that return coming, after that bottoming in mid-October to end October. We're heading towards that, right? This is the last day of September. There will be a seasonal pull to pull the market up here as we get through these midterms. And, the real reason, I suppose, is that there's uncertainty before and the market kind of drops. And then as the election happens, that uncertainty is resolved. We know who's in charge of what, and the market starts to recover and come up and then makes up for some lost time, right? Because it just gets on a roll. This particular midterm election year, it's pretty far down on the list of things that we have going on between the pandemic, this not hyper, but high inflation, and this situation in Ukraine and Russia. All those pieces are kind of commingling to make me wonder if that seasonality this year will be enough to pull through all of that. When you've got the world's Federal Reserve just ratcheting up rates, and you got the dollar skyrocketing, you got financial pressure that's being put on these firms and countries, does the seasonal aspect of the midterm election overcome that? I think that'll be really interesting to see. It will be a part. It will possibly at least hold the market up more if it was going to come down and that type of thing. So there's some reasons behind it as far as that goes. I wouldn't say it's the thing to use to trade on, to look at that heavily, because seasonality breaks down a lot, in my opinion. But the midterm one is one of the stronger, I don't know if I want to call it seasonality, but because it's not quite a season, but it's pretty strong, and so we'll see how that plays out.
So, where do I get my money to help pay for my daughter's wedding? I'm retired at 62. I have some money in my Roth IRA, emergency fund, and a traditional IRA.
That's a pretty good question. Think about it. So, daughter's wedding, who knows what that means dollar-wise, but obviously could be a lot. Um, and being asked to, help or wanting to help. You've got three buckets that you mentioned there: the Roth IRA, the traditional IRA, and emergency money. So let's take a look at that. So the worst place you can get the money, in my opinion, is the Roth IRA. Ironically, it's the easiest to get because there's no tax to take it out. But you give up, whatever. Let's say you're going to pay $25,000 towards this wedding. You give up the tax-free growth on that $25,000 for the rest of your life on that. Last place I go. All right. So then the next worst place, I guess, would be the traditional IRA. And again, when you take $25,000 out, now it's taxable. You might have to take out 30, 35, 40,000, depending on your tax bracket, to net 25. So that just made the wedding a lot more expensive in a way. And then whatever you took out, let's say you took out 35,000, that's no longer going tax deferred for you either. And generally speaking, your IRAs and your Roth IRAs are set up for kind of long-term growth, and you're kind of giving some of that up. So that leaves your emergency account. Now, I'm sure the daughter thinks that this is an emergency, right? So she wouldn't have any problem with that. If I had to choose between those three, those aren't great choices, but I would choose the emergency account just because you do have a chance to then, replenish it over time. You take the 25,000 out, and that's sort of what it's there for. So you don't have to take out. This would be a terrible time to take 35,000 out anyway because the market's down.
Yeah.
And that's what the emergency money's for, to kind of live off of during these at least in my opinion, during these downturns. And so here's a situation, that comes up. Maybe it's not a pure living expense, but it's still important. And so, again, it kind of depends on how much it is and how much you have. That wasn't defined in the question, but that's probably where you go, right? And then you try to replenish that and resave that money back into that emergency account to get it up to the level that makes you comfortable, right? As far as that goes. So that's a pretty interesting question.
Yeah, the most common sequence of withdrawals for people is taxable first,
Right.
then you go with tax deferred, and then tax free.
Yep.
And so that's where you should usually target, especially in a down market. Usually emergency fund is always in cash, so it's not going down anymore. So it's bad. It's rough to pull when in a down market withdrawal from those IRAs.
Yeah, just because that you take money out of 25, 35,000 out of an IRA, and the market turns around and really starts to take off, because that is a pretty normal occurrence here. At some point when that bottom comes in and the market starts to move, it will move usually quite strongly upward, at least for a little while. And so you could find that you just gave up another $5,000 or $10,000 worth of gains that you could have had too. So there's a lot of cost to withdrawing from those other assets. I hate really going after emergency money because that can make people really nervous. But I guess I'd rather run down the emergency money, see what happens. Hopefully you don't have any other emergencies. And you then could, if you had to, you could withdraw from your IRA, right? It's the next one on the list. And, hey, if you have to, you have to. That's why we have a lineage. But anyway, it's a really good question. It's a really interesting thought process. But that's what I would do. And it's what we call a sequence of withdrawals.
Yep.
And we've talked about that several times in the show. It's actually one of the more important things that you do in your retirement is figuring out where to take the money from, because you would be absolutely stunned on what happens to your overall net worth if you take it in the wrong sequence versus the right sequence. It is one of the things that people really probably don't completely understand. We talk about it all the time, trying to get that through as an educational. Taxable, tax-deferred, tax-free usually is the best sequence. So in this case, the taxable account is the emergency. That's where you start. So that's pretty good. All right, so we've just finished another show, another Friday. I'm so happy that you came today. There's some good questions today, too, so hopefully you got something good out of this. And, of course, we'll be here next Friday. Send in your questions now. Ask Tom with talkmoneywithtom.com. Let us know what they are. Be happy to try to answer those here live on the show. And then, of course, you can subscribe to the channel. You know, work on your education in these areas. You will be rewarded for that. Your retirement will be potentially more sound, and maybe you'll sleep better at night, kind of, you know, having more and more knowledge about what's going on. And heck, it's just fun. Learning is fun, right? I mean, that's something. This is something that isn't taught. This channel is designed to help you learn. And then lastly, you can just set up an appointment with us if you would like, and you go to our website. Link is here on the channel. Go up to the corner, you see a button looks just like that, and you hit that button. Our schedule's live, 30 minutes, phone, video with Ethan and I, and we'll talk to you. So thank you very much for coming today, and I look forward to seeing you next Friday.